level in nearly a month. Also, crude oil right near $50 a barrel, its highest level since July.
But the question is, what'd you miss? An exclusive sit-down with Janus Capital Management's Bill Gross. Our Eric Schatzker joins the star fund manager at a Bloomberg fixed income panel in Los Angeles later this hour.
Plus, why China wants the Fed to raise rates in July, not June. We're going to look at the potential impact on financial markets and the UN.
And Costco stock has fallen more than 10% this year. We have the charts that you can't miss before the company reports earnings overnight. We begin with our market minutes. The Dow gaining around about 150 points. The S&P 500, as you mentioned, at a one-month high. 9 out of 10 major S&P 500 groups gained risk-on.
It was like the risk-on rally heard around the world. It started in emerging markets. They rallied there the most in 6 weeks. The MSCI Emerging Market Index actually closed right above that 200-day moving average. Brazil was killing it. Russia was killing it. Then it kind of spread to Europe. European stocks also rallied. Then it spread here to the U.S. A lot of follow through from that rally that we saw yesterday, which can be very constructive. Bank, tech stocks doing really well. The one not so great stock, though, was Yahoo, sort of the outlier, down the most since January 7th. You got all these companies bidding for you and your stock is down. I mean, that hurts.
It does hurt. But one thing about Yahoo that everyone always has to remind you about is that it's become like a tracker stock for Alibaba.
Right.
And Alibaba also tumbled about 6.8%. So that might explain some of the weakness. Let's get to those European stocks that you mentioned, because like yesterday, the rally followed gains overseas, and we saw the Europe Stock 600 gaining 3.5% over the past 2 days. That is the biggest back-to-back advance since February. It also climbed above the short-term trend line, the 50-day moving average, with all 19 industry groups up over the 2-day period. So a pretty concentrated, or I should say broad-based advance. At the same time, here in the U.S., we saw the VIX ease for a second day to 13.8, roundabout 13.9, let's call it. The average this year is 18, so clearly we're far below the average, and the historical average is right around 20. So you could call it complacency, if you like.
Yeah, amazing. In terms of the bond market, the big story in the bond market had to do with Greece. At one point, its 10-year yield falling below 7%. It didn't wind up closing above that level, but nonetheless, below 7% as a Greek basically got its bailout deal. Last July, that yield was 19%, just for perspective for you guys. Here in the U.S., the story is the yield curve continues to flatten. It's flattened right around the lows of the year. That basically means, yes, the Fed's going to hike in the short term. However, long-term investors are still worried about growth and lack of inflation. The 2-year yield has rallied 20% in weeks. The 10-year yield rallied just 10%. That just shows the difference in market expectation.
Such a huge move in that short-term treasury. Now, in terms of what it means for the currency market, we've seen the dollar rally, of course, gaining almost 3% since early May. That's prompted China to take action. You can see that Beijing weakened its yuan fixing to the lowest since March of 2011. And according to people familiar with the situation, Chinese officials plan to press their U.S. counterparts next month on the odds of a U.S. rate hike in June. They would prefer, they are expected to say, to have a rate hike in July.
All right, well, in commodities, to me, the story was really about oil. A monster rally in Brent as well as WTI. Stockpiles dropped big here in the U.S., but also the Brent rally was kind of weird to me because you have these French refiners who are still on strike, so they're not using the crude, yet Brent still managed to rally, almost touching 50 right there.
All right, those are today's market minutes. Let's take a deep dive now into the Bloomberg. You can find all the following charts using the function at the bottom of the screen.
All right, well, speaking about oil, I'm looking at the result of the Canadian wildfires here in the U.S. This is the Balkan WTI spread. So basically, it's oil in the Midwest versus the generic U.S. WTI. Now, just about a few months ago, right around January and February, that spread was $3 as you wind up having so much oil locked in Cushing. And now that spread is 30 cents. And that really goes to show the tightening in the market due to the Canadian wildfires being taken offline. We saw inventories drop by about 650,000 barrels last week in Cushing. So I love watching this spread as an indication as to how tight the market really is in the Midwest.
And it's pretty consistent, too, so you wonder if there's more room for it to tighten as well.
Well, it depends on when that Canadian supply comes back online.
All right, meantime, I'm taking a look at at Tiffany. It's had a pretty rough go because of foreign exchange changes and also less spending from overseas tourists. But one bright spot has been those lower product costs. Diamond prices in blue, fittingly enough, in robin egg blue, it's been down over the last couple of months. And what you'll really see, of course, is that has translated into higher profitability for Tiffany. That's that yellow channel there. Gross margins are in white, and it was above 61% in the most recent quarter. Tiffany shares, by the way, closing little change, just up 4 cents at 63.89. You can see all those charts and more on Twitter.
Well, joining us now is Oliver Rennick, stock market reporter for Bloomberg. Now, Oliver, stocks really had a nice follow-through from yesterday. That typically is a bullish sign, strongest two-day rally in nearly 3 months. Investors saying, hey, the economy maybe not so bad.
Pretty solid move, yeah, indeed. And I think the economy, hopefully, I think is part of it. Perhaps that's why it's a little bit more sustainable. I mean, the question the past 2 years, really, since we started talking about tapering, since we started talking about higher rates, was don't let the Fed go at the wrong time. Right now, this time last year, we were in a very similar kind of predicament where people were saying to the Fed, hey, here's a pretty solid window, June, July, could we be ready for this maybe? Then the Fed didn't go. Markets got a little bit freaked out, and then they didn't end up going until December. So I think after all this, if we've learned one thing, it's that markets are okay with the Fed going if the data it corroborates their own views on the economy. And you've had some pretty solid stuff with home sales. You've had some pretty solid numbers with PMI staying above 50, and I think that's important in the home sales as well, because that kind of gives you a picture about the average American, the consumer, and there were a lot of questions raised about that in the past couple weeks. So hey, if the data's there and it's solid, then maybe we're actually ready to do this thing, and I think that's big.
Okay, quick note here on HP, which just reported results. This is, of course, the hardware division of the company. What we have right here is second quarter adjusted earnings of 41 cents, beating the consensus estimate of 38 cents. Revenue in the personal systems business was down 10% year on year, so double-digit declines. In the printing side, revenue also falling 16% year on year. When it comes to the outlook for HP, for this quarter, HP is looking for profit of 37 to 40 cents a share. The consensus estimate is 40 cents, so perhaps on the high end, meeting the estimate, the average analyst estimate. For the full year, HP is looking for profit of anywhere from 159 to 165. So at least what analysts are looking for, which is $1.59 on average.
A different story from what we saw yesterday when HPE
with the
came
software,
out. Right, exactly, the software version of the company. Yep. Okay, Oliver, you're talking about the stocks versus the actual economic data. You have a chart that looks at the home builders versus new home sales. We saw that huge jump in new home sales yesterday. Yeah. Home builders, though, have had a huge rally since 2012, but if the eco data continues to support, what happens to the home builders?
Yeah, I mean, it's pretty interesting because you basically had an index, home builders, where year to date has been a tiny bit weaker, and it's finally getting a large bump here. But as you point out, over the longer term, this has been a really positive part of the economy where past 3 years, there's been some strength in home building, there's been some strength in home sales. Now, I mean, I guess if you have mortgage applications that are solid yesterday, you have the numbers on the home sales doing good, perhaps these are going to continue to be the beneficiaries of that. It's a pretty substantial part of the market, too. I mean, I don't know the market cap right off my head, but it's a solid group of stocks that people look for as sort of an indicator in which way we're going with the economy. These are the type of things I think this week that people are looking at when you have these economic-focused stock groups doing really well.
So now it's look at the home builders, not the transports, kind of. Like that's a better sign.
If you want a positive view on it, yeah.
And as we look for the Federal Reserve to raise rates, whether it's June, July, or September, you've been focused on the banks and specifically the differentiation by investors between mid-cap and big banks.
Yeah, that's my talking point this week is mid-caps. But this is interesting because you have had a pretty strong outperformance by the mid-cap banks. Those are the smaller banks. I mean, if you just looked so far this year, that orange line, those are your mid-caps S4 Fennel Index, S&P Mid-Cap Bank Index. It's just really taken off, and that hasn't been the case the past year and a half. I think part of that, there's two things going on. The one is the net interest margin story, which is a loan story, which the smaller banks, that represents a pretty big part of their business. Previously, when we thought we were going to have a dovish Fed, we weren't going to have hikes till further out, that obviously is not going to be good for those companies that rely on that type of income. So as we get to a more hawkish Fed, that language, I think, pushes those stocks up. And then at the same time, if you go and look, and you just take the worst returners right now in the S&P financials, it's the big banks. It's Goldman, it's Morgan Stanley, it's all these companies that are having some issues in terms of their capital markets business, their trading businesses, and that obviously is not as big of a factor for some of those smaller cap banks.
Well, and not to mention, mentioned that I feel like part of the trend this year has been the rotation from growth to value stocks, and if this is the year we're really going to see that rotation take full effect. And banks, I mean, most of them trading below their book value, and all of them.
They're value traps, some would say.
Or value traps, yeah.
Sure.
But
I mean, valuations definitely plays a big part in the market right now, I think. In fact, when you look at the big gains we have in stocks and the big losses we have in stocks, a lot of times you can see a pretty close correlation between valuations where people kind of question whether or not they want to be in the companies that are expensive. So that's definitely a factor, I think, that's taken a little bit of the front seat, where if you're an investor and you look at a group of stocks and you have all these metrics, then yeah, I think valuation at this point definitely is a big part of it, because even though the S&P has been rocky, valuations are still pretty high relative to the start of the year.
So Oliver, as you do your stock market reporting and you talk to investors, both short-term traders and people who are focused on the near term and those who are focused on the long term, what are they looking for to happen this summer? You've got a lot of potential headwinds here, whether it's the FOMC or whether it's the Brexit vote and the U.S. elections. Are they bracing for a lot of volatility this summer?
You would think so by their actions, and we've talked a lot about how minimum volatility funds have become popular. My colleague Joe Scioli has covered a lot of that. That's certainly part of it, so you think that people do want to kind of get in that. Now, an interesting question that we were talking about on our team yesterday is what kind of investors buy into those funds, and that does raise some interesting questions. Are those people that want to buy a low vol ETF as a replacement for the S&P, or are they just doing it as a hedge? It's kind of hard to know, but that type of trade has definitely been popular. You've also seen pretty steep contango in the VIX, which would indicate volatility further out. June's a big one, though. It's June. I think June, once we get past that, you're going to be able to try and get a better gauge on what's going on. Then maybe the presidential election will come into focus. Right now, I think there's just still a lot of questions about that. But June's definitely big. You've got Brexit, you've got Fed, and it seems like the Fed is kind of set on going, but the market right now, the Fed funds futures, still not 50%, right? I think the market is kind of taking advantage of the past couple of years, and they think that, look, if we don't push up Fed funds futures above 50, the Fed's not going to go, and that could be a very rude awakening. Perhaps traders have gotten a little bit cocky there.
Yeah, and just looking at the work function on my Bloomberg, you can look right now at the probability of a rate increase on June 15th right now is 34%. For July, it has crept up to 55%.
And that really dovetails into the VIX curve you were just talking about. If you take a look at the Bloomberg here, this is the VIX curve, and you can see what happens in June or July. There's a spike here in 2016, and then it kind of like meanders along, and then a huge spike up in the beginning of 2017. So to your point, that's pretty steep contango actually in the next couple weeks.
Right, and I think it's a big part of it. The fact that there is this sharp move up in the futures, and talking the Fed funds futures, it's still only to 34, 38% or whatever it was the other day. So bottom line is roughly 2/3 of the market is going to be very taken aback if the Fed goes. Even though we're seeing positive sort of moves this week, and it is on the back of some strong economic data, you got to think that after so long, of the Fed sort of, crying wolf for lack of a better term, and the market being able to get away without a rate hike except for that one last year, you got to think that's going to surprise quite a bit of people. I think perhaps part of the reason why we're gaining now is because they're still banking on the fact that, look, stocks are still a little bit below their highs, and Fed funds futures aren't pricing it in, so the Fed's not going to go. They like to listen to the market, but if they're wrong.
Still too skeptical there. Oliver, thanks very much. Oliver Rennick of Bloomberg News.
Coming up, China turns from foe to friend in the Fed's quest to raise interest rates. Why China wants to help temper volatility when the Fed does move on rates. And a quick check on shares of HPQ. The company, which is the computer and printer business, lowered the high end of its 2016 fiscal year forecast. And Pure Storage is getting hit hard in late trading. You can see they're down 13% after reporting a loss of 26 cents a share. That was bigger than what was estimated.
Is your business ready to break through? Cohn Resnick, Accounting, Tax, Advisory.
I'm Mark Crumpton. Let's get to First Word News. The head of the Transportation Security Administration says the agency will add 768 new screeners by mid-June to deal with increasingly long airport security lines. Peter Neffinger told the House Homeland Security Committee today that several factors have contributed to added wait times this year, including more passengers and a shortage of applicants for the government's expedited screening program. A State Department audit blames Hillary Clinton and previous secretaries of state for poorly managing email and other computer information. It cites, quote, long-standing systemic weaknesses related to communications. These started before Mrs. Clinton's tenure as Secretary of State, but her failures were singled out as more serious. The Romanian hacker known as Guccifer, who accessed the computer accounts of the Bush family and others, has pleaded guilty to identity theft in federal court. Marcel Lazar also admitted to unauthorized access of a protected computer. He's best known for hacks that revealed private Bush family photos and paintings connected to former Presidents George H.W. Bush and George W. Bush. Lazar also hacked into the email account of Hillary Clinton confidant Sidney Blumenthal. That hacking led to the revelations about Mrs. Clinton's private email account. President Obama's in Japan to attend a G7 summit. At a news conference with Prime Minister Shinzo Abe, the president discussed his scheduled visit Friday to Hiroshima, which was leveled by a U.S. atomic bomb during World War II.
Our visit to Hiroshima will honor all those who were lost in World War II and reaffirm our shared vision of a world without nuclear weapons, as well as highlight the extraordinary alliance that we have been able to forge over these many decades.
Mr. Obama will become the first sitting U.S. president to visit Hiroshima. Prime Minister Abe says he has no plans to visit Pearl Harbor, which was destroyed by a Japanese air assault during the war. Global news 24 hours a day, powered by our 2,400 journalists in more than 150 news bureaus around the world. I'm Mark Crumpton. Scarlett, Alex, back to you.
What'd you miss? Well, China trying to avoid a Fed-driven market tantrum. Chinese officials are trying to deduce when the U.S. central bank will raise rates. And according to Bloomberg reporting, the best-case scenario would be for July.
So for more on how the Fed plans to manage expectations, Paul Scheer, the chief global economist at S&P Global Ratings, joins us now. Paul, great to see you again. What kind of consideration should the Fed give China when it comes to the timing of a rate increase?
Well, to be brutally honest, not very much at all, if at all. I mean, the Fed's job is to set monetary policy for the U.S. economy, so I think that's what they'll do. And, you know, it sounds like China's in the boat of all the other Fed watchers in the world, which is trying to figure out, when the Fed's going to move.
Having said that, the Fed has alluded to Chinese developments or Chinese instability or global developments, however they couched it in previous statements. So clearly they are mindful of the ramifications of what they do.
Yeah, I mean, that's the way to think about the international implications of Fed policy moves, or any central bank policy moves for that matter, is there some feedback loop that would come back into the United States because of the Fed's action? But that's a pretty indirect kind of mechanism. And I think for a central bank to be able to divine that with any sort of confidence and then make that the basis of essentially moving the policy decision, I think that's a pretty long bow to draw.
But nonetheless, I mean, China has to be very concerned with not repeating what happened in the beginning of the year, and then, of course, what happened in August. Take a look at the Bloomberg here. This is the dollar versus the yuan. What you see right here is kind of that leverage spike. We had a lot of money coming in. You had a big devaluation of the yuan back in January. A similar story happened in August. This is dollar, obviously, so as it goes up, the yuan goes down. We saw China start to take some steps today to sort of lower their band at a 5-year low currently. What kind of steps do you think China can realistically take to smooth whatever transition comes their way?
Well, I think the irony with this discussion of China and the exchange rate is, of course, that China is at last moving towards a more flexible exchange rate mechanism. They want to free up the renminbi exchange rate. So I think the volatility that we've seen, actually, although people make a big deal about it, is not that big. I mean, I think relative to August last year, the renminbi's probably moved about 5% against the dollar, which in the grand scheme of things, is not a huge move. So I think the Chinese have to kind of stick to their knitting, continue with the reform process. process, make sure that the domestic markets are developing in such a way that they can, absorb the consequences of freeing up the renminbi. So it's a long-term project. Good communication obviously would help, but I don't think, Alex, that China's going to be able to get through this process without, from time to time, and maybe frequently, stirring up a little bit of the nerves in the international markets.
And of course, we got to talk about dollar-yen because that was the topic of conversation at G7, with the U.S. officials saying they don't really see a problem, while Japanese officials have made clear that too much volatility would be damaging.
Yeah, and you actually had the finance minister Taro Aso saying that a 5-yen move in either direction for 2 days would be considered one-way and lopsided. Did you feel like that was this will be our threshold for intervention?
Well, I think, probably the finance minister kind of broke maybe one of the golden rules, which is don't put numbers on these things. The position of the Japanese authorities has been, pretty much over many years now that they do not target a specific level of the yen. Obviously, they operate an inflation targeting regime with a flexible exchange rate, but they would be concerned about volatile and abrupt movements that were out of line with fundamentals. So I guess Minister Aso is putting some numbers on that, but definitely there has been a bit of a gap open up between the rhetoric, at least, of the US and Japan around the exchange rate.
And with your 2 decades of experience in Japan, your sense right now of Abenomics, it was a big deal when it first came out. It's kind of waned in terms of whether people believe in it or not. Do investors inside Japan believe in it?
Well, I think you have to always divide Abenomics, Scarlett, into 2 elements. One is the bid to end deflation, to get Japan out of that 2-decade deflation. And, that's going reasonably well. There's still some further work to do. The second aspect of Abenomics is really structural reform, measures that can be taken to try to arrest the steady decline in Japan's potential growth rate. Sorry, that's a mouthful. But that means, innovation, but it also at some point means doing something about the decline in the population. That obviously requires, pretty dramatic policy changes. Very different from the central bank engaging in, say, a QQE, which they've done. But I think on the monetary side, things are going relatively well.
All right.
So maybe they trust it. Paul, thank you very much.
Pleasure.
Paul Sheard of S&P Global Ratings.
Coming up, Costco is set to report earnings later this evening. So next, we dig into its numbers and take a look at why it's been slow to follow the shift to e-commerce by other retailers.
We do have some breaking news concerning Theranos. The company is being sued in a class action suit that's claiming fraud. This class action suit is accusing the company of false advertising and negligence in the lawsuit. This is filed in Northern California court. Remember, the company had to void 2 years of testing, of blood testing, and now Theranos is being sued in a class action fraud suit. Scarlett?
Well, let's talk about Costco. It's pursuing a different strategy than other retailers. As the industry focuses on expanding e-commerce and putting the brakes on store growth, Costco sales depend on adding physical stores. Let's dig into the numbers in today's The Numbers Don't Lie. So Costco stock has fallen more than 10% this year. And when you compare it to the broader market, especially over the past 12 months, Costco outperformed in the fourth quarter and in the first quarter before running out of steam and pretty much meeting up with the S&P 500. Little changed over the past 12 months. And the reasons are a stronger U.S. dollar and falling gasoline and food prices. They're both weighing on Costco's same-store sales growth, which is the white line there. Now, when you back out FX and gas, there is a clear outperformance there, the orange line. For the bottom line, watch for the impact from Costco's plan to raise its minimum wage for the first time in 9 years. That'll be a factor. Costco plans to add about 20 new stores a year, both domestically and internationally. And you can see here the company's capital spending, which is now at its highest in more than 2 decades. The concern here is that Costco could be vulnerable with the store expansion and fall behind in e-commerce efforts. So where would they expand? Costco, which is this first set of bars here, is big on the West Coast and clearly has room to expand in other regions compared to its rivals, Sam's Club and BJ's. BJ's obviously dominant in the Northeast. Ultimately, Costco is about its members. The company aims to keep renewal rate above 80%. Executive members made up for almost 40% of the membership base last quarter and 2/3 of all sales. Costco added 18,000 executive card holders per week in that quarter. Costco will be reporting results later on this evening. Alex?
Well, Scott, we're going to much more coming up on What You Missed. We're going to have an exclusive interview with Bill Gross. We're heading to LA, where Eric Schatzker is sitting down with a bond guru, Bill Gross of Janus Capital. It's an hour-long fireside chat. We're going to bring that to you live.
I'm Mark Crumpton. Let's get to First Word News. House Speaker Paul Ryan has told reporters he has not come to a decision yet on the endorsement of Donald Trump. Earlier, two people close to the lawmaker told Bloomberg News Speaker Ryan was ready to end the standoff. Those people said Ryan may endorse Trump for president this week. The speaker was said to be concerned about the split that's developed within the Republican Party. More troubles for the embattled Department of Veterans Affairs. The agency mistakenly declared thousands of vets dead, canceling their benefits between 2011 and 2015. The VA reportedly has acknowledged its mistakes and changed the process for confirming deaths. President Obama and the First Lady reportedly have selected a home for their post-White House residence. Politico reports the Obamas will lease the mansion of former White House Press Secretary Joe Lockhart in Washington's Colorama neighborhood. The home was built in 1928. According to a new United Nations report, food assistance has reached only 42%, or just over 200,000 people trapped by war in Syria. The report says more needs to be done to help some 13 million people in need. Global news 24 hours a day, powered by our 2,400 journalists in more than 150 news bureaus around the world. I'm Mark Crumpton. Alex Scarlett, back to you.
Thank you so much, Mark. Let's get a recap of today's market action. It was risk on, not just in equities, but across the asset classes. Here, though, is a snapshot of what equities did. The Dow added 145 points, the S&P up by 0.7%, closing near a one-month high. The Nasdaq also at a one-month high at 48.94. With the Dow up almost 150 points, we saw energy and materials leading the way. 9 out of 10 major groups higher. You really had to look hard to find some decliners.
Yeah, and it was really the rally heard around the world. We had the big rally in stocks yesterday. Then we had follow through over in emerging markets. Emerging market stocks rallied the most in 6 weeks. You had actually the MSCI Emerging Market Index closing above its 200-day moving average. That rally spread over to European stocks. They rallied there. And then here in the U.S., banks and tech really led the way. And seeing that kind of upside follow through when you have a really monster rally one day and then you can build on it the next way, definitely makes technicians and short-term traders feel really good about the rally that they're seeing. One stock that did not do so well is Yahoo. At one point, it fell its lowest level since January 7th. It fell its most since January 7th.
I got it.
I mean, you get a tech rally, people are bidding for you, and your stock is down. I mean,
but you know, Yahoo has really become a tracking stock for Alibaba, which is one of its biggest holdings, and people betting on what it does with that stake and how it positions itself after it sells it off or spins it off or whatever it eventually decides.
Right, and Alibaba was down, as you pointed out earlier, so there you go.
All right, well, let's stay with the U.S. stocks theme here, because in my deep dive, I'm looking at cyclicals versus defensives. Cyclicals, which are the white line here, are still on track to be the defensive companies since the low in mid-February, which is the starting point here. They've gained about 18%. The blue line, which are defensives, have gained about 9%. If you look at the past year, however, very different story. You could see that the defensive have outperformed versus the cyclicals. And according to Richard Bernstein of Bernstein Advisors, the CEO and the CIO there of its own firm, he says all it takes for cyclicals to outperform in 2016 is to not repeat what we saw in 2015, which was a stronger dollar and lower oil prices that pushed people into those defensive names like utilities, like consumer staples.
Oh, okay. So the Fed raises rates and the dollar goes higher and oil says off because it ran too fast, and boom.
Maybe.
There you go. All right. Well, I'm looking at what's going on in Venezuela. They're selling a serious amount of gold. They cut their reserves by 16% in the first quarter. That was the biggest gold sale by a central bank in 8 years. So this is a quarter-by-quarter look from 2008 to 2016, and you can see the biggest 4 out of the last 5 quarter gold sellers actually came from Venezuela. So when they come out and say, guys, we're going to repay our debt, don't worry, our debt is not a problem, we're going to repay it no matter what, this is what they're doing. They have to sell gold in order to raise money to pay off debt and support their government. I thought that was a fascinating kind of look into just the real struggle that Venezuela is going through.
Venezuela is such an economic basket case right now. We talked earlier with the director of the Eurasia Group, Risa Grace Targo, and she was talking a little bit about whether production would falter. I mean, yes, it will, but probably not to the zero level, which is what some people have said could be the scenario in a worst case situation. But it really raises the question of how much social unrest all of this generates with people waiting in line because Venezuela has cut off the imports to save on cash.
Well, talk about social unrest. That leads us to some after-hour breaking news. First off, comes Theranos. It is that blood testing startup company that's come under some scrutiny over its technology, actually had to void 2 years of its tests. Well, now that company is being sued over claims of false advertising, unfair business practices, as well as negligence that is filed in a federal court in San Francisco by a resident of Arizona who's doing a class action suit on behalf of everyone else.
All right, we're going to keep track of that news for you. Meantime, we're going to take you now live to Beverly Hills, California, where Eric Schatzker has an exclusive sit-down with the bond king himself, Bill Gross of Janus Funds. Let's listen in.
Well, I don't, but if I told you the truth, I could tell you again.
Bill told me that he needed to prove, in his words, that I've still got it. To himself, no less. Here we are, Bill. It's May 2016. Your Janus Global Unconstrained Bond Fund is up 2.5%, slightly more, in fact, year to date. He's outperforming PIMCO total return. He's outperforming double line total return. Looks to me like you still got it.
Well, thank you. And it's a short period of time. I mean, to prove that you've got it, I think, as you all know throughout your careers, takes more than a year or two, which gives an emphasis to me to keep on going to prove it. And so I shall. But thank you. I'm satisfied with the results. It doesn't sound like a lot of money. It's not. But as we'll talk about in the next few minutes, there are reasons why. And I'm proud of the returns and hope to do better.
You have a smile on your face. Are you having fun?
It's always fun in a rather tension-filled way. I'm sure professional basketball players in NBA playoffs have fun, but they're also,
tension-filled.
Yeah, tension-filled, and so that's always the case on a minute-to-minute basis and a daily basis. But it's fun for me because it's competitive. It allows me to try to outperform the competition and hopefully succeed, and that's important to me.
You've described your competitiveness, to me anyway, as borderline unhealthy. At what point will you have proven to yourself that you've still got it? How long does it take?
Well,
because there's some people, let's remind everybody that, and I don't mean this the wrong way, you're 72. There are people, 71 still? Whoops. There are some people who wonder, you being a Duke graduate, when Bill Gross is going to hang up the high tops. And you're clearly not prepared to do so yet. And I just want to know, what is the period of time over which you need to prove it to yourself, which is perhaps metaphorical for all money managers?
Well, I think it almost takes forever, which is not a good explanation because we can't live forever, can we? But it takes a long time, as we were discussing backstage. I've been in the business for 40 years or so, plus or minus, but it's been a period of time in which credit has expanded from $1 trillion to $58 trillion, in which financialization of the economy has taken place, and the economy has prospered enormously. I would like to have the opportunity, I won't, for another 40 years to be able to adapt, perhaps to a different environment, because I think that's the real test of an investor, to be able to change directions, to take another road, the road not taken, as Robert Frost would say, at the right time. And hopefully I can do that in the next few years, but not for the next 40.
Let's talk, though, about the point that you just made, adapting. A lot has happened since 2008, and things have happened since you left PIMCO and moved to Janus. How have you had to adapt to changes in market structure, changes in the regulatory environment, which may not affect you directly, but certainly affect you indirectly?
Well, Lehman did change lots of things, and at the end of significant levering has changed the environment substantially. It's produced, in many cases, zero and negative interest rates. It's artificially elevated asset prices. It's, as you mentioned, it's injected a regulatory tone to markets and a diminished potential for liquidity going forward. First person out of the theater. So yeah, lots of things have changed, and so that's one of the things that I hope to adapt to going forward.
Well, this is something you're dealing with, and many people in this room are dealing with right now. The challenges that you confront as an investor in a world of limited returns, certainly for the assets you're buying and selling, and minimal, if not non-existent carry. Let's talk about that.
Sure. Well, it's most obvious in Japanese and European bond markets. I mean, I could convince all of you, I would hope at a drink at the bar over here, that a negative 25 basis points on a 5-year German Bund does not provide a sufficient return. As a matter of fact, you wind up paying them. So that would certainly be a twist or a turn of the tables relative to where we've been in the past. And it's a similar type of case with U.S. interest rates, although not so obvious. It's not obvious that 1.8% on a 10-year or 1.4 on a 5-year in today's auction, for instance, is an artificial interest rate. But you would have to assume that because of the globalization of financial markets, that the bond markets themselves are price elevated, yield
depressed.
Thank you. Yield depressed, and that importantly, other assets, which is the critical thing, other risk assets, whether they be high yield bonds or equities with PE ratios or even private equity, that their current prices are elevated as well, and that their future returns are not 0%, but are lower than historically expected. We know from our days in graduate school or undergraduate school, in terms of the Gordon discount model, that the interest rate discounts future cash flows of all risk assets. What we don't know is what the proper risk premium should be, and that's why an 18 PE ratio or a 450 basis point spread on high yield is debatable. But I would simply suggest that if in fact they're tied to the policy rate in developed countries, which we know are artificially low and negative in some cases, then it's a fairly good assumption that other asset prices are artificial as well, and so we must be careful.
Care, clearly, is something you need to take, but how else do you approach the challenge of investing in an environment like that? How do you think about it that is different, say, than what you're accustomed to doing over the past 40 years?
Well, you think about it first from the client's standpoint, and you know that investment management charges a fee, and you know that your clients, whether they be a pension fund or insurance company or even a private individual, that they have expectations and in some cases legal requirements to earn a certain rate of return. In many cases, that seems to be very difficult. For instance, a pension fund that has a 7 to 8% estimated return on assets, to my way of thinking, will experience trouble in attaining that rate of return, and so something must happen. Taxes must go up, or contributions and payouts must diminish, or something happens when investors can't return what they hope or expect, and that would be in an individual's case, education or retirement or health care. If the past was an expectation of 10% return and now it's much lower, then things change. And so as an investor, my first obligation is to alert them to that fact, and to say, I can strain for historical returns, but in an environment of high risk, that's something that I probably shouldn't be doing for you. I will measure risk and return in proportion and provide the highest return relative to the lowest risk possible, but the client itself must recognize that they have changes to make as well.
Now the problem, perhaps for you, but clearly for others, is they don't want to accept the reality that 7 to 8% is going to be difficult to achieve. And so they're reaching for yield and reaching for returns.
Right.
And that is helping perhaps to propel asset prices to these unrealistic levels you described. How much longer can that go on for? I mean, this is the eternal question that, again, everybody in this room and everybody who's watching or listening is wrestling with.
Right. Well, prices can stay elevated as long as central bank policy and the private market, which believes in the efficacy of central bank policy, allows markets to maintain at least a status quo. So it's a Wizard of Oz type of thing. We are traveling down the yellow brick road and have gone down the yellow brick road. We're in front of the wizard stage now, and hope that the wizard, whether the last name be Yellen or Draghi or Kuroda, that they have some authentic magic, behind the curtain. But increasingly, it's obvious that something else is needed besides monetary policy, and so investors, should be aware that prices can be supported, but if and when their magic fails to produce economic growth or in that magic 2% inflation, the disappointment at the margin can begin to move markets the other way.
Well, you're providing me a convenient segue. Everybody here knows that your monthly musings are a must-read, but the May investment outlook was especially intriguing and provocative, and I'm making the assumption that lots of you have read it. For those of you who haven't, in the May investment outlook, Bill talks about the revolution underway in automation and roboticization, and how policy needs to respond to the dawning machine era. And he goes so far as to argue for a universal basic income. Why?
Well, I didn't actually argue for it. I suggested that it was coming.
It's an important distinction. Fair point.
An inevitability of it. And to a certain extent, we already have that in many countries, and even in the United States with food stamps and tax policies that provide assistance to those that have been displaced. But
why is it an inevitability?
Well, because society, a civilized society, pays a price for civilization. The old phrase, taxes are the price we pay for a civilized society. It's the price we pay in order to keep things in order and calm. And I'm not suggesting an eruption in the United States, but we see that frequently in other parts of the world, and a society needs to be bounded and bonded together in order to keep it civilized. And so, at some point, the displaced workers, and we have, by the way, just for a number, we have 150 million Americans older than 15 that are working, and we have 100 million Americans older than 15 that are not working. The rest are less than 15. The 100 million is an increasing number, and the political argument can be argued either way, and that's why I said it was not necessarily my opinion, but the political argument as to why people aren't working, some should be working, but there are others that they can't work and can't find a job because technology has displaced them. And so, a society, in some form or fashion, has to take care of them.
Because the alternative is pitchforks?
The alternative is unrest. Put it that way, unrest, and in some cases, great unrest.
Is that the reason then that a lifelong bond investor, somebody who, as a matter of principle, should be terrified of the thought of inflation, is growing accustomed to, or at the very least getting used to, this idea that there will be raw stimulus in the form of helicopter money?
Well, we've had that to a certain extent. Helicopter money is sort of a metaphor for a combined fiscal and monetary authority. It doesn't mean that helicopters are going to. Would that they could. I'd be looking up myself. But what it does mean is that a central bank buys the treasury bonds, or a central bank buys JGBs and uses the money from a fiscal authority standpoint to stimulate the economy, and it could be through through infrastructure spending, or it could be through tax cuts. But it's a combination of monetary and fiscal policy, where a central bank basically buys treasury bonds and then gives the interest right back. Some of you may not know this. It's fascinating, but the $4 trillion that the Fed bought, they earn interest on it, but at the end of the year, they give it all back to the Treasury. And so what does that mean? That means the Treasury has issued $4 trillion worth of debt for free. And that's a rather startling observation, but it happens in Japan, and it happens to some extent in the UK, and it's a little muffled in Euroland because the different structure. But fiscal and monetary authority is combining by necessity in order to provide stimulus to economies. It's just that from a fiscal standpoint, we have differences. Republicans and Democrats have a different idea as to how to spend money, but ultimately, helicopter money gives that opportunity.
Let's go back to this question of how you deal with that as an investor. If the world we live in now is a world of asset prices, perhaps largely distorted by central bank policy, what would a world like that look like?
A world with distorted...
Well, a world in which fiscal and monetary policy are working hand in glove.
Well, it's not, there's a danger there, and that's why the Fed fiercely fights for its independence, and other central banks to a certain extent. Ultimately, if they're combined in one, then it allows the fiscal authority, the government, to basically spend as much money as it wants because it comes for free. And we know that just conceptually that's dangerous. And so there is a danger in combining the two authorities. That's why the Fed was made independent of the government itself for the most part. So we don't. I don't think as investors we should like that, but it's almost happening by necessity.
Let's just weave politics into the fabric for a moment. How do Democrats, and for that matter, Republicans, get to the same point you're at, which is at the very least acknowledging that something like this is going to be necessary, let alone palatable?
I think it's hard because we are in the aftermath of a Great Recession, and we can look back in our books, and we all went to school and read about the aftermath of the Great Depression. We know it takes time, a long period of time for attitudes to change, and it takes time for economies to delever to a point at which they can grow again.
Can you imagine having this conversation with Donald Trump?
Well, no. Or with Bernie Sanders.
Really?
I mean, even though Bernie Sanders would be for lots of spending, I don't think he recognizes the delicate combination of finance and economic growth, and so I think they all would be rather obtuse when it comes to a potential solution. Not that mine is an educated opinion, but
well, it's an informed opinion.
Well, yes, but it's just one opinion.
Well, to give you a little bit more credit than perhaps you're giving yourself, so far, the new normal has more or less played out as you predicted. And I'll use your own words to ask this next question. Can we save this pumpkin?
Well, by the pumpkin, I assume you mean capitalism, because I think almost all of us would agree, even Bernie would agree, that capitalism is the best system going. It has its flaws, but like democracy, it's with us, and we want it to be with us. We want it to thrive. So, if capitalism is the pumpkin, can we not only save it but rejuvenate it? Give it a healthy sheen, like a pumpkin should, before Halloween, not afterwards. Yeah, I think it's possible, but we need an acknowledgement, like your previous question asked. We need an acknowledgement that both sides of the government need to be pulling in the same direction. I mean, monetary policy has been easing, and fiscal policy hasn't, in my opinion, really done its job. It's been contracting to the point of a near balanced budget, at least in the United States, and certainly in places like Germany. And that's a Keynesian type of idea, and there are those of you that would oppose that. But I think in extremis, when you're trying to save the pumpkin, like Roosevelt did or tried to do in the 30s, some would argue it was the war that really bailed us out. But the government needs to take a temporary place of the private sector if the private sector is unwilling to invest money, and that appears to be the case. So saving the pumpkin requires a change of attitude, I think, fiscally. Easily call it infrastructure spending. That's an easy one for most of us because we know the shape of our roads and bridges and airports and so on. But we need both authorities to be pulling in the same direction in order to make a start. And we do need to maybe get to another question. We do need to renormalize interest rates. Capitalism cannot survive with 0% interest rates. Capitalism requires risk and risk taking. And to your point of carry that you mentioned 20 or 25 minutes ago, when sufficient carry isn't available, meaning a sufficient yield on a long.
That was Bloomberg's Eric Schatzker with Janus Capital's Bill Gross in Los Angeles, and you can continue watching that conversation at Bloomberg.com.
And that's all for What You Missed. Thanks so much for watching.
We'll see you back here tomorrow, everybody. Have a wonderful evening.
It's the email, what, the email.
The email, what, the email. To whom it may concern. Oh, it's an official email.